Breathe.
Welcome back.
We were both so quiet. We were loud and then we weren't. But here we are. Welcome back, Jennifer. It's been forever.
It
What?
has been too long, Kevin Weedmark.
Yeah, you've been busy. You got amazing listings with a new development, and you've been busy. Clients coming into town, all your adventures. I see them.
It's happening. It's all happening.
Good. Welcome back. So, for our viewers, our plan is to, at the end of every month, break down what happened, do a monthly recap of, hey, what the hell happened this past month? Because it's craziness. And then just look out the month ahead and give our experts'
Yes.
opinion of where we think things are going. I think that would be really beneficial to not only our listeners, but to one another.
Love that about us.
I'm going to touch on three things. Obviously, we have the geopolitical front. I think that's huge. I want to talk about that briefly. We're going to talk about how inflation affected us this past month. And then the one thing I think that everyone's not noticing, because there's always focus on jobs, but it's really the issuance. So it's the government spending, how much this war is costing us, and how that affects the 10-year Treasury and the government having to step in and issue some more money and mortgage-backed securities. And now the market is thinking we might could potentially looking at a rate increase. So I'm going to recap those, discuss interest rates really quick, and go from there. What about you?
Awesome. I'm just going to talk a top line of what's going on in the Austin market, a little bit about the sentiment and what's happening in the whole market versus what's happening in the luxury market. Let's do
Awesome.
it.
All right. Let's talk about the geopolitical front first, right? If you look
Because
at
that's exciting.
it's unbelievable, right? I think everyone I've spoken to, and probably you as well, is everyone is in shock that it's actually lasted this long. The mantra going in was this is going to be quick, it's going to be pretty efficient, it's going to be easy. They'll capitulate and we'll close the book and we'll move on. And I think a lot of that thought process was due to our success in Venezuela. But obviously, as we can see, much different. It's taken a lot longer. And the posturing for this past month has not been anything militarily. It's been really, let's just choke them off on the street and choke them off financially and see if that will work. If I pull this up, if I remove it and I add this to the stage, this is our 10-year Treasury. If you look at the last 3 months, late February, early March, the 10-year Treasury was below 4%. And now we've seen it all the way as high as almost 4.7%. And a lot of that is driven by the oil market. So if you pull that up, there's somewhat of a similar correlation here when you can see oil spiked all the way up to 115. And now you see it down around 90. And as that moves, we're going to also move. So big messaging here is from this past month is traders have a lot of uncertainty surrounding this geopolitical moves. Oil is really kind of dictating where the 10-year Treasury goes. And then obviously that spills into inflationary concerns, which would be the next topic that we discuss here. All of that combined just has 10-year Treasuries elevated. And now as the market is really priced in a potential rate increase by the Fed towards the end of the year. What are your
So
thoughts?
it's honestly, I'm afraid. Uh, I think our global economy is breaking right in front of us, and a lot of us just don't see it. And that the stock market right now is cool. The bond market is the one that matters the most. And right now, that bond market is signaling that our economy is going to crash.
Yeah.
So I don't know, Kevin. It's when the U.S. government starts to need to borrow money and sell IOUs, that gives me pause.
Yeah. Look, the bond market really dictates global activity, right? Because
Mhm.
our stock market is all based on US earnings and stuff like that. And earnings have been great, which is why the market's actually doing the exact opposite of what one would think during this time,
Yeah.
because earnings with AI are just blowing people away. So that whole thing is just taken off and everyone's running with that. But you're right. On a global scale, as you talk about what has happened is oil has obviously been choked off. So everyone is dipping into reserves. So now as I look, if we jump ahead, let's just stay on the geopolitical side for this coming month as we now drag into June and July, if this continues to go on, because I think this administration right now is having grave concerns of going back in with military activity. I think a lot of politics plays into it as much as Trump likes to say, I'm not political. Look, he's a politician. Midterms are coming. Everybody's political. So I just think there was an opportunity to go in there and do what we needed to do militarily. I think he's attempting now to backpedal a little bit and build a coalition with choking off the strait. So yeah, I would agree with you. As this continues to play out, the supply of oil that everyone has is becoming a critical measure of, yes, we could fall into a global recession. We could fall into some global decline in GDPs. And this could be a really big problem, I think, as this moves into this next month, June. And if we're in July and we're talking the same shit, we're in for some real problems. But I agree. I don't know if I'm overly crazy concerned at this point because we're energy independent, but on a global scale, yeah, I think it could present a real problem.
Yeah, and I honestly, I listen to a lot to what my friend Mike is putting out in the marketplace, and he studies economics, and he's saying that he's been calling for this for a long time. And so basically, the way he framed it is if the US government needs to borrow money and they head out bonds, lend out money for 30 years on these with Treasury. And so then the US government gets money back for 30 years, which is simple. Then for the last 17 years, the interest rates on a 30-year US government bond has been below 5%. And then on May the 13th, that rate broke above 5%, which is the first time it's done it since 2007. And so if we look at 2007 and 6 days later, it climbed even higher. So if you translated it the same way as Fed kind of lost its steering wheel because our economy with interest rate cuts, borrowing cheaper, people get to spend money on businesses and hiring again. That's where our economy seems to really go. But between September of 2024 and December of 2025, the Fed cut rates 6 times to stimulate the economy. And look where we are now. We're like, we've gone up, we haven't gone down.
Yeah,
So it's a little scary right now. And if history is every indication, then like you said, I think some things are going to change and could change drastically.
sure. Yeah. And look, when the government is borrowing and doing issuance, bonds have to go up because people just demand more payback to invest in bonds at that point because you have inflation also going up. Look, where I think this really needs to go, I think the time has passed where we needed to go in and do what we needed to do. Unfortunately, it's just one of those things. They don't look like they're going to give up the uranium. We're telling them that's the only option. So unless you're going to go in and do it militarily and just basically just give in and put all this behind us and try to sell it to the American people is why you went in and why it was a good cause and go that route. You have to do one thing or the other. But the longer this continues to go on where we're trying to choke them off financially, I think you can build a coalition. But again, you're up against the clock right now at this point, like you alluded to. It's at a critical time where oil and supplies is becoming a big problem on a global scale. Now, let's just put all that behind us. Inflation. Inflation obviously is reading higher. And one would think it's just really recently starting to increase. Today, we had an inflation report and it came in right at forecast, which is fine, but it's still over 3%. So it's well above the Fed funds target. They obviously were not able to get it under control when perceivably we weren't in this global conflict or even with the tariffs. They still didn't have it under control under the prior administrations. The Fed kind of put us in this position, but now inflation's an issue. You see it when you go to the grocery store, you see it in gas, you see it across the board. And the longer that oil sits at around $90, it's just going to continue to increase prices across the board. And we as Americans just have to deal with it. But it's a problem because inflation is a long-term concern, which means bonds aren't as sexy, which means interest rates once again stay elevated, which is what we're more concerned about as it pertains to real estate.
Yeah. Because if the bond buyers don't believe that the Fed 2% target is realistic, then and BRICS and everybody is losing faith, we've got a geopolitical problem. So that part is gonna really prove interesting over the next little while, and like you said, if we don't do something, and the US government doesn't get faith put back into where we are right now, we're fiscally trapped. We've got 39 trillion in debt. That raises something like 3 trillion a year. So it's not something that even this president created. We've been going, if I could trash him at any given point, I'm happy to, but this is this long and coming thing. And so the implications right now on a global scale, I think, are massive. So we're going to find out as we go. But as far as lowered interest rates, I don't expect that to happen. And I think that generally the people in the world don't expect that to happen. And here in Austin, that and then translates over to what we're seeing in the buyer side and the seller side of in our April rates. And we can move to that whenever you're ready. But it's in Austin, I think the situation here is a little bit different than what people may anticipate.
Yeah, again, inflation is a major concern
Mm.
because the cost of everything just goes up. So it isn't like we're going to flip a switch. So oil is going to come down. It'll probably come down to around $80. But until it starts flowing regularly like it was, and that's going to take months, you're not going to see oil back down to 65, $68 a barrel, which is where we were right before the conflict.
Yep.
The fact that only $20 over right now is pretty crazy. If I said, hey, we're going to have inflation that's accelerating, we're going to be in a conflict, a war, we're going to have $39 trillion in US debt, you would be like, holy shit, interest rates are going to be 8%, 9%. It's the mortgage backed security market. It's the
Yep.
purchasing by Fannie and Freddie. It's the GSEs buying mortgage backed securities. And it's obviously private investors buying them as well. And that's really what is keeping those spreads low. They're
Hmm.
2% right now, which is why if we're sitting at 4.5 on that 10-year treasury, 4.4, you can get 8% to 6.5 right now. And it's because of that mortgage backed security markets. But I think, like you said, I think the demand side is there. If we just talk about the general consumer of real estate,
Sure.
people want to move. I think people want to move. I think the demand side has been building up for quite some time, particularly here in Austin, Texas. I just think all the news and this conflict and everything like that just had people in quicksand, just a lot of uncertainty of what it's going to lead to. And here in Austin in particular, hey, is there still a future market correction? I think that's the biggest thing that has people on the sidelines. Because if people talk to me about how to manipulate the interest rates and get demand, do it at no closing costs, utilize yield spread premium, you can get creative. You can save thousands of dollars and you can get into the house you want as long as you can afford the payment, and you can manipulate it so you can pay lower interest rates right now, cover all your closing costs, and wait for those future interest rates to drop. The concern is just, do we have more of a correction? I think that's the biggest thing I'm seeing in people sitting in Austin, in particular, on the sidelines.
Yeah, absolutely. All right. So let's talk about it then, because right now we've got Austin proper versus the suburbs.
Yeah.
And so basically, sellers are waking up, and if they're waiting for the perfect time to list their home in Austin proper, then the inventory in the city is actually drying up. It's down 14%, but in April.
Wow.
So, yeah. So before you celebrate, though, and raise your price as a seller, you need to hear what buyers are actually doing, because whether you're a buyer or a seller right now, let me know in the chat, because I've got things to consider. Number one, Austin proper is tighter than the metro. So the city itself is a little bit of a pressure cooker, with active listings dropping 14% down to 8,600 home. So in terms of months of inventory, we're at 4.3 months of inventory, and we've been much higher in the past year. Our median sales price ticked up 1.3% to $465,000, which is nice to hear for Austin, because we've just been in this bit of a nosedive. While the luxury homes in Travis County are selling in about 21 days if priced correctly. The average regular home in Austin right now is taking 65 days to close. Does that surprise you?
No, actually, those numbers all seem down. If you look at that, 4.5 months of inventory to me is healthy, right? I'm not in the 6 month camp. I think that's too high. So I think anywhere between 4 or 5 months, I think that's a healthy market. It's a good balance between buyers and sellers. I'm surprised to hear that the price has gone up a little bit, given,
April versus April.
yeah.
Yeah.
Yeah, I'm shocked to hear that. I thought it might have went down a little bit, but you're talking the city itself is very appealing. So yeah, at 65 days, I don't think that's that long. I think you'd like to have it a little bit less, but I'm pleasantly surprised by those numbers, and numbers don't lie. So it sounds like it's a decent market to be investing in it.
Yeah, it is surprising. And so Austin proper is insulated in a number of ways. With the broader metro was a bit softer because it dropped 1.9% to 440,000. So if you're buying in the suburbs, then your opportunity is greater for a deal. And if you're selling in the urban core, you may be sitting on a gold mine.
Do you think that has a lot to do with once you get into the suburbs, you're talking new builds, right? And builders get aggressive. So do you think that has a lot to play in it, or you just think the suburbs in general are kind of just behind downtown? And I think that's probably a general thought. I'm just curious.
I think I could go with that general thought. Again, I like to, when I'm looking, I look at the specific area. I look at the specific city. I look at the specific school zone, the specific neighborhood, and then the streets in that neighborhood. And so I really do consider when it comes time to shopping, because none of us buy in Austin. We buy in a part of Austin. We buy in Westlake. We buy in Barton Creek. We buy in Northwest Hills. We buy in Great Hills. But then when we go outside of the Travis County, the Bolden, all of this stuff, then we start looking at, okay, where are we buying? What's happening in Bastrop? Bastrop is
Explodes.
lit right now, as the kids would say, just based on all the things that we have going on with Elon. And so that factors in hugely with what's going on. I just met a guy this weekend who recently moved here for SpaceX. It's just, there's so many people that are coming to town to go to work on various things. And depending on which company you work for, you may be seeing yourself coming in and being in the outskirts. And so this guy was actually looking, he wants to be in Austin proper, and he's willing to do the drive out to Bastrop. Could he get a lot more house in Bastrop? Yes, but could he get more life in Austin? And that's what's more important to him. So we
Yeah.
just have to weigh what's important for buyer psychology and lifestyle. So again, I would get really specific on where. If you're in Hayes versus Williamson, Dripping is always a solid market. And whereas in Georgetown now you've got a lot more choices, to your point, new construction. And depending on the neighborhood, if you're looking in Sun City, you got a ton of choices right now.
Yeah.
So again, it just depends on what your bracket is. If you're shopping under 450, 500,000, or you're shopping above it, and then we look at it that way. So I think that there is a solid amount of buyer confidence though, because we've been where we've been for as long as we have. And if I was a buyer right now and thinking about making the move, especially before the school year starts, I would be looking at getting locked in as soon as possible before rates go up even higher. That's just my take.
Yeah.
Survey.
Like I said, I think buyer demand is there, right? I think buyer demand is actually, there is confidence because the market's doing really well. So you dive in and you go look at your portfolio, you're like, shit, I'm still making money.
Yep.
You look at wages, wages are going up. They're staying in lockstep, if not beating inflation. So
Yep.
that's the thing, right? So
Yep.
those things continue. It's just the overall uncertainty on a global scale and the perception, once again, right? We had 2 or 3% rates. So now you have to go pay 6.5%. Everyone's like, oh shit, that's really expensive money. The one thing I like to remind everybody, if you're listening, the cheapest money you're ever going to borrow is against your house. I don't even care if it's 8%. No
Sure.
one's going to give you a $500,000 $1 million at a level of 8% and term it over 30 years. So if you think that's expensive money, maybe it's just the payment that's too expensive and you're over leveraging yourself. Maybe your budget's just too much. You need to scale it back and you need to go find the proper place that fits your budget because that is the cheapest money. I think just recapping last month, and I don't want to steal your thunder, but from what I heard, market's healthy. If you look at it year over year, it's the prices are not plummeting. So that's a good thing. See 5 days on market. I think that came down. I think our high levels were over 80, if I remember correctly. So that's good. And right.
Yep.
Activity is there. There's not as many sales, obviously, given the current economic environment, but overall, it's not horrible. It's not like it's fallen off the face of the earth, and there's opportunities all over the place. So what do you think now? Let's put our caps on and we have to predict. What do you think now? We're in May. We're now coming into summer. It's going to start getting hot. Although, hey, we're blessed right now. This weather in Austin has been amazing. Because some years it's been over 100 right now. So this is choice. What do you think? What do you think for June? What do you got? What's your crystal ball tell you?
The question is the Austin housing market secretly exploding. And if it is exploding in a good way or a not so good way. And the numbers that just dropped for April, and everyone is talking about a slow market, $1 million homes are selling. In Central Texas, our luxury sales shot up 17% year over year. But the real madness is in the suburbs. So in Hayes County, luxury sales skyrocketed like 76%. In Williamson County, homes are over $1 million are going under contract in 10 days. Inside Austin proper, the regular inventory has plunged. So the takeaway is buyers are officially done waiting, Kevin. They saw the prices soften a bit and jumped off the fence. And they're now looking at being back in the market and clearing things out. So I think if you are waiting for the crash, you might miss the turn before we start heading to higher interest rates. What do you think?
I think this conflict still has weeks to go. And I think that's a
I
big
think it
concern.
has months to go.
I'm hoping that in the next 3 weeks, it gets resolved one way or the other. And what do I mean by that? Either we come to an agreement or we go back in militarily. And if we go back in militarily, then yeah, rates are they're going to skyrocket. But let's hope at that point, if we do that, it's quick, it's fast, and it just puts an end to it. So I'm saying you got 2 or 3 weeks till we get a decision one way or the other. I don't think we can
Mhm.
keep waiting and waiting for this agreement that just does not seem that it's going to come. So I think in the next couple of weeks, we get some direction in that regard. Should we come to some level of agreement, I think you're going to see that 10-year come down. I don't think it's going to be a drastic drop because once again, we got to wait for oil and all that, everything to catch up. But I think we'll see an improvement in interest rates, but they're going to remain elevated. There's no doubt about it. I was
Yeah.
predicting best rates late Q3, Q4. I'm now looking at Q1, Q2 of next year. Because the three things that are really going to affect interest rates this month, obviously the geopolitical front. It's the biggest driver right now because it affects everything else, right? Affects oil, which drives everything. Inflation is going to be the second one. It's the biggest thing from just a US economy standpoint, because if you have high inflation, then you can't have lower interest rates. They don't jive. It's just the way it is.
Mhm.
The Fed's kind of the third thing. So we do have a Fed meeting coming up this coming month in June. And I think their vernacular is going to be it's gonna move interest rates one way or the other. They've already alluded to, instead of being more dovish, a lot more are becoming hawkish, ones that were dovish. So that has changed. So the market's already priced in one rate increase towards the end of this year. If the Fed comes out and says, holy shit, we're in this conflict way too long, inflation's going to take months and months, if not another year to correct itself, and so on and so forth. And now we need two. You're going to see the 10-year Treasury probably escalate from the 4.5 that it is today. Our new normal will be about 4.7.
Okay.
So once we start getting up into that range, if we have a military conflict escalate, we could be looking somewhere between 4.8 to 5%. And then you're looking at interest rate close to 7%. So do I think all of that's going to happen? I don't. And I don't, because like I said, I think this administration, as much as they're like to say, I'm not political, everybody is. I think midterms are a big problem. And I think the overall, like you said, the global pressure of bonds being up near 4.7 to 5% is way too heavy
Yep.
for everybody, just on a global level, let alone the US economy. And I don't think this administration or anyone in Congress just cannot have that. So you're going to do everything possible, which is what I think they're doing now by trying to negotiate some level of agreement instead of going in militarily. I think they're trying to do that at all costs to avoid that catastrophic approach. But do I think it's a good time to buy a house? I do, because like I said, you can use yield spread premium. And there's a lender right now till the end of June giving a 1-year free buy down for conventional and govy loans. So you could take a higher yield spread premium, cover all your closing costs, use the free 1-year buy down, and you're in the high fives with all your closing costs paid.
Wow.
I mean,
We lost Kevin, disappeared from the live stream. That's fun. Let's add him back. And you're back. Welcome back, Kevin.
oh, I was going.
I was
That
like,
was weird.
we lost Kevin from the
That
live.
was totally weird. I have no idea why.
That's okay.
But anyway, what was I saying? Oh, so the approach is just being tactical, being strategic, utilizing what is sitting
Mhm.
out there available that you don't know about. So instead of being like interest rates are high or interest rates are this, like you said, there's great houses out there. The band is there. So you want to make moves. I think once all this conflict and come Q1, Q2 next year, you're going to start to see housing appreciate once again. Do I think it's going to go crazy? No. But right now, you have the ability from a buy side to negotiate sessions, to have more product that's available to you. Everything is sitting in the buyer's favor here in Austin, Texas. So
Yep.
I just look at it and I'm like, what are you waiting for? So
That's a good. There we go. I love that. Let's end that one there. So here's my soundbite.
go.
You ready?
Yeah.
All right. In the luxury space, this isn't a slow recalibration anymore. High net worth buyers took advantage in April of the temporary spring rate dips and they cleaned house. Unintended. Sellers who price realistically are winning instantly, and those who are greedy or don't have both feet on the ground are getting left behind. We have multi-million dollar deals that aren't sitting around. Buyers have locked them down in a median of 18 days. The pricing paradox is that regional luxury median price actually dipped 3% to 1.338 million. And the buyers didn't back off because they saw this minor discount and they pounced. There's this massive space between if you're looking at where you are now and moving up, it's those houses that are worth more that have taken a bigger hit, which has closed the gap for the move up buyers. So even if they're sitting at a lower rate, there's an opportunity to buy a house that's taken a bigger dip. And then ultimately down the road, take the rate for what it is today and then refi down the road. But you are going to get the real money, and the real purchaser win is in that gap based on the discount of the higher price. And in the big picture, we had 270 luxury homes over $1 million close in April across the tri-counties. And that is a 17% spike versus last April.
Wow. Yeah. And if I'm a buyer, my advice is I'd be more concerned about, can I get a better deal on the price than I'm concerned about the interest rate? Because the interest rate
Yep.
is going to move. It's only going to improve from here
Yep.
in 6 months, year, 2 years, doesn't matter. And there's temporary solutions, like I already talked about, working with somebody like myself that utilizes yield spread to pay for closing costs. free 1-year buy downs. There's ways to manipulate to get your payment close to where you want to be, whether it be temporary or longer term. I'm more concerned about the purchase price because that I can't change in the future. That is going to be fixed. And that can save me thousands and thousands immediately over the term of my loan. That's real dough. That's real money. So
Real
I think at
money.
this point, those deals are to be had right now. In times of uncertainty, people are willing to deal. When things are great, everyone's like, yeah, my price is my price. Somebody else will come and take it. So I'd be really leery in sitting on the sidelines.
All right. And there you have it. Welcome back to What's Brewing. For those who have joined us, we are back. We're going to look at these monthly talks. If you have questions for me or Kevin, please feel free to reach out to us. All our contact information is in the show notes. My name is Jennifer S. Goodman. I'm a local realtor here in Austin, Texas. And I am joined by my fabulous co-host,
Kevin Weedmark, Len nationwide in all 50 states, and been doing this over 25 years. And as I said before, strategy is your biggest friend right now. So be very strategic. Don't sit on the sidelines thinking you can't. There's so many solutions out there. Just make sure you're talking to the right professionals. That's really what it
Abs-
boils down to. So
and there you go. And I cut you off, which is perfect. Everything is back to normal, Kevin.
exactly.
I love
All right,
this.
Jen. Love you. Good to see you. And thanks everyone for joining. And we'll be coming to you next
Month.
month.
We're coming back next month. We'll come back with a little summer action.
Yes. All right. Talk to you soon. Bye.